While considering the state of the economy, it's always a good idea to keep an eye on debt figures, as this is the likely area to cause a recession or a stock market correction. And recently, the total U.S. household debt is now $993 billion higher than the peak of $12.68 trillion in the third quarter of 2008. That, according to a new report by the New York Fed. So, let's take a look. According to the Fed's quarterly report on household debt and credit, household debt increased once again to the level of $13.67 trillion dollars and was boosted by increases in mortgage, auto, and student loan balances, which are the trifecta of consumer debt. While looking at this chart, it's also important to see how quickly the debt is acquired. Back in the time frame of the years 2004 through 2008, it's apparent that the increase in debt levels was much more dramatic than it is now. In my opinion, this will likely help the overall debt situation, as the increase does not appear to be creating the imbalance as it did back in the 2004-2008 time frame. But what do I know? I pay off my monthly credit card debt. Since I have no other debt, it's easy for me to see the issues through my rose-colored glasses. This chart here shows the serious delinquencies, which are the payments that are late by 90 days or more. And I don't mean to minimize the situation because serious delinquencies are rising. But again, and without considering the student loans, all other loan levels, including auto loans, credit card loans, mortgage, and revolving loans, are well below the levels from the year 2008 to 2009, right during the great financial crisis. Of course, if a shock to the economy were to occur, things could quickly change. But for now, although the risk of a recession is rising, we still have some time. Although many economists would not necessarily agree with me, Fitch Ratings Senior Director Michael Tiano says we are not yet seeing signs of an inflection point in consumer credit cycle in the issuer performance data. He went on further to state that what we are seeing reflects the seasoning of a resumption of consumer debt growth over the past few years after a period of stagnation following the financial crisis. Lastly, Tayano said that we anticipate some worsening in the credit performance this year relative to last year when there were a number of macroeconomic tailwinds, including the tax cuts. So it's not that surprising to see some credit deterioration this year. And again, as looking at this chart here, the number of accounts by loan type does not appear to be sending up any red flags at this time. Looking at this chart, which shows the transition into serious delinquency by age for credit cards, which is the most popular and common form of credit used by consumers, some see a worrying increase in the number of serious delinquencies, specifically the age group from 18 to 29. That demographic, which includes Generation Z and late millennials, are finding it more difficult to repay credit card debt. Credit card delinquency rates have been trending upward in the past few years. This likely reflects the increased presence of younger borrowers in the credit card market. As you can see, the trend is not really an immediate cause for concern because despite this recent deterioration, credit card performance remains better than it was during the pre-Great Recession years of 2000 through 2006. This chart here shows that the current total amount of student debt is up to about $1.6 trillion. dollars. Reportedly, the percentage of student loans transitioning to delinquency rose to 9.54% in the first quarter of 2019, and that's up from 9.8% in the fourth quarter of 2018. So the implication is that this number is likely understated, as the Fed has warned about half of these loans are currently in deferment, which are grace periods or in forbearance and therefore temporarily, not in the repayment cycle. This, in my opinion, is the one major concern for the economy, with money being sucked out of the economy from having to service these loans, and with the delay of household formations and the limitations resulting from the lack of house buying. The economy has an imbalance and could tip into recession. But that has not happened so far, since the progression of the loan increase seems to be sustainable, at least for now. But rest easy, as I'm watching out for you. So for today, that's ChewDog Charts. Thank you.